A very good evening, friends. Myself, Sanjeev Singhal, Central Council member and chairman of the Auditing and Assurance Standard Board. I welcome you all to this virtual CP meeting of the Auditing and Assurance Standard Board of the ICAI. And friends, this is the 26th program of the AASB in this council year and 8th program for this month, wherein we have started a series on the auditing standard seminars and the webinars. And this is really overwhelming to see that generally 3,000 plus members are joining each of these webinars. And by 15th of May, we intend to cover all the auditing standard. In each webinar, we are taking 2 to 3 auditing standards. We have 46 auditing standard. By 15th of May, we'll try to cover all, and then we'll start covering CARO and other guidance note relating to auditing. And then this process will go on. We have requested all branches also to host one physical program each on the auditing standard. And friends, today today we'll be covering 3 topics. Agreeing the terms of audit engagements, SA 210, initial audit engagements, the opening balances, SA 510, and subsequent events, SA 560. These 3 are very, very important auditing standard. Why? See, agreeing the terms of audit engagement. So unless you have that engagement letter, unless the scope is clear that what is the scope that an auditor is required to do. Of course, scope is defined by the statute also. Say, for example, in case of a company audit, it is the audit report under the Companies Act plus CARO plus the internal control over financial reporting. That is the scope. But then you must agree all the terms of audit engagement, including the fee and everything. Management responsibility should also be laid down in black and white. And similarly, when you take up the first audit engagement, then checking of the opening balances. So what's the auditor responsibility? Is he required to redo the last year audit? Certainly not. But needs to ensure that the opening balances are tying up with the closing balances of the last audited financial statements. And subsequent events, friends, we all know that there is a time gap between the end of the financial year and the date on which the financial statements are adopted by the board, and then an opinion is expressed by the auditor. In between, 2 types of events may happen. These could be adjusting events and the non-adjusting events. So while the accounting aspect is dealt by Accounting Standard 4 and Ind AS 10, respectively, but the auditing aspect, what is auditor's responsibility with respect to this? Say, for example, if there was a heavy amount of money recoverable from the debtors on 31st March, but if the debtor has become bankrupt, say on 15th of April, and the financial statements are signed on 15th of May. So what is the auditor's responsibility? While the management will do the accounting, what the auditor has to do? Or if a new regulation has been passed, which actually does not relate to the conditions existing on the balance sheet date, what is the responsibility of the auditor? So this auditing standard covers such matters. And friends, I have the great pleasure today that we have today two very renowned speakers, CA Amit Purohit and CA Rais. And but above all, it's a matter of great pleasure for me that our honorable past president, CA G Ramaswamy, with whom I have also participated in some of the board meetings of the Accounting Standard Board when he was the past president and I was not into the council. And since then, I have seen his contribution to the profession, and that has really been immense. So he was very kind that he agreed to give the keynote address, and also in the recently released Corporate Law Committee report, he was one of the member of that CLC report, and CLC report contains a number of provisions which talk about the ease of doing business and about strengthening the audit framework. So his contribution in that regard was also very valuable because this was a high-level committee constituted by MCA, and it was actually in operation for more than 2 years. Although I know that our honorable past president does not need any introduction, but still young members join the profession and they may not have heard much from him and about him. So let me tell you, friends, that our honorable past president G Ramaswamy ji hails from Coimbatore, and he's a commerce graduate from the University of Madras. Besides being a chartered accountant, he's also a fellow member of the Institute of Company Secretary. He's an honorary member of the Association of International Accountants UK, an honorary member of the Institute of Chartered Accountant Australia, an honorary member of the Certified Public Accountants of Australia, resolution professional member of the IBBI and IPAI of ICI, advisory committee chairman of the Indian Institute of Insolvency Professionals of the ICAI, and he's the first president of ICI from Coimbatore. He has more than 35 years of standing in professional practice, and he was a member of NACAS as well as the Government Accounting Standard Advisory Board for Union and the states constituted by the C&AG of India. He was elected as a Central Council member for the first time in 2004 and held various positions. And finally, he led the profession from the front as the president of the Institute in 2011-12 during the 21st Council of the Institute. He's also been an independent director of Chennai Petroleum Corporation, and he was nominated by the Ministry of Petroleum and Natural Gas Government of India. He's also serving as the chairman of the Audit Committee and chairman of the CSR Committee of CPSL. He's also served as a board member of the IFAC, which is the parent body in a way, where all the chartered accountant institutes are a member, and he represented for 3 years from 2011 to 2014. He's the first member from the southern region to hold this distinction. Friends, he's also been a former member of the board of the CAPA and former member of the XBRL International Steering Committee. And of course, he has also served in the disciplinary committee of ICI in various positions, and also served as a member of the quality review board of the government of India for 2 terms. And during his tenure, he has handled complex issues. The list is very long, and I don't want to stand between you and the honorable past president. But I can tell you that he takes very active interest in the social work. So sir, really, we are very thankful to you that you are present, and your social work also reminds me that after half an hour we also have a meeting with the NGOs on the social audit standards, which the work institute has been entrusted with by the Security Exchange Board of India. So we are really overwhelmed by your presence, sir, and I would request you to kindly guide the members by giving your keynote address. Thank you, sir.
Very dear friend, Sri Sanjay Hingal, the chairman for the WASB, Mr. Vishal Doshi, the vice chairman for the WASB, very good expert speakers, Amit Rohit and Mr. Rashidi, and fellow members and friends. At the outset, I must thank the chairman who has given me this wonderful opportunity to meet all of you on this virtual platform. In fact, very recently, I got a call from one of the leading newspaper, and a person has called me. What is your opinion about an expert panel constituted by the WASB to provide support for the chartered accountants, especially for the small and medium practitioners? I interacted with Mr. Sanjeev Singhal relating to the initiative started by our institute. In fact, I am very happy to see that after a long time, I can see that we are all returned to our root. Our root starts from auditing standards. When I was a student for this profession, the main debate between all of us in every meeting is about the standards, auditing standards prescribed for us, especially relating to the audit engagements, and another related to the subsequent event. And of course, after the starting of this tax audit, many issues related to the standards relating to the opening balance verifications and everything. So 3 standards today we have taken: SA 210, SA 510, SA 560 is a very important standards for any professionals. Those who have joined this profession, they must be aware of all these things. But by practice for a long time, they may not be able to implement immediately, or some of them may be missing certain important points. When that particular question raised by this press reporter relating to this WASP's initiatives, I immediately reacted for it. One of the best moves started from the WASC by the ICA of Institute of Chartered Accountants of India, as after this Chartered Accountants Amendment Act 2021. Of course, I heard that now it's 26th program. It must have started earlier, but I'm very happy to see that the proactive reform started from our continuing professional education side. Continuing professional education, very important for all of us in a different field. But this is the fundamentally, we must understand what is in our essays are guiding our members. I'm very happy to see that. So I reacted for that. And I received many communications from our chartered accountants, what type of expert opinion they are going to give, why there is the hiding of an experts and all these things. I very clearly mentioned to them, it is a first initial move from our ICA. Please accept it is a positive move and go with the ICA. Later on, whatever you want as services from the ICA, support from the ICA, you can just move it. There is no doubt ICA is with the members. Especially, I must compliment the present chairman, Mr. Sanjeev Singhal, the Dr. Sanjeev Singhal, for this good initiative. And its initiative should continue, and it's a very wonderful initiative. In fact, this Chartered Accountants Amendment Bill was presented in the Parliament, and it was referred to Standing Committee. I have seen the Standing Committee's report and all these things. There were a number of debates happened in the first time in the history of the Chartered Accountancy profession. I can see that the amendments have been vehemently argued in the Parliament in the first time related to our Chartered Accountants Amendment Bill. Finally, it is passed by the Parliament with its wisdom, its own wisdom, with a lot of other lessons which we have to learn from out of the debates and discussions. What is important today is we have seen that the corporate failures many times. We debated about all these things. We have taken corrective measures. We have given all direction to the professionals, what type of an action to be taken, what are the areas we have to consider for the purpose of correcting our professionals and standards and everything. Similarly, very important initiative we have started very long back, which has been approved by the Chartered Accountants Amendment Act 2021 relating action against the firm. Imagine a partnership firm is subject to the disciplinary proceedings because now the act is very clear. If there is a mistake committed by one partner, whole of the firm is also subject to consideration of these disciplinary proceedings. Even a person is not involved in any of these activities, any of these audit processes, any of these opinions given by them, any activities on behalf of the firm, if there is a failure in the nature of which are all subject to some disciplinary mechanism, naturally the firm also subject to all these processes. So it is a time for the partners of the firm sit together to decide how to move their firm in a further step. That's a very important initiative every firm has to start now. Naturally, our fundamental job is auditing. The complete guidance given by our institute on various aspects relating to our auditing standards, continuous meetings organized by our professionals, our institute for the upgrading their knowledge by our professionals is also very important. In fact, a common people are thinking any certificate issued by the chartered accountant is free from all misstatement. There is no fraud in that the financial statement certified by the chartered accountants. That is an opinion in the minds of the common people. Even educated people are under the impression that once an auditor certified that it's a valid one. But nobody understood that audit has its own limitations. There is a difference between audit and investigations that we are not able to distinguish before the society. I'm happy to see that now the message is loud and clear to the society. There will be a complete focus about the auditing practices by our chartered accountants, and the difference between auditing practices is the investigation that is going to come. Recently concluded our the company law committee constituted by the Ministry of Corporate Affairs. We have debated many issues relating to our profession as well as the corporates. One important point which we have debated about joint audit. So certain level of companies should be considered to be appointed by the 2 auditors, 3 auditors, 3 or 4 more auditors. That is the level of entities that's to be decided later on. But there is a move for appointment of joint auditors for corporates of certain level. So what it shows that, so there is a checks and balances between the audit firms. They are going to take up the audits. We know that we have a complete structure with us. ICA has given the guidance note for the joint auditors, how best the joint auditors together to draw the line between their activities, their responsibilities and everything. But if there is a failure of one joint auditor, it may be further other auditor also has to suffer all these things. So if there is a failure of a one partner of a one audit firm, it has an impact on the other audit firm also, because of the latest amendment in the Chartered Accountants Amendment Act 2021. So one firm suffers because of the one partner, it may be percolated to the other firm also in case of a joint audit. Another very important aspect relating to the investigations. We have seen that the growing figures of the NPA, the actions taken by the government on this controlling of in the NPA, and the insolvency and bankruptcy code has been fully utilized by all the financial creditors to recover their money, to bring out their proper resolution plan. There will be a lot of haircut, everything is happening. So naturally, this fraud investigations is going to be a very important area for our profession. So when it comes for a fraud investigation, forensic audit also going to come. So fundamentally, now this audit profession is going to be a very important profession in the economic areas, especially in the case of an offense committed by the borrowers or a willful defaulters, failures of the corporate, so many things. So naturally, this is a very important aspect. And I can see that the ICA has taken a good initiative, organizing programs. I think a very limited way. I can appreciate that instead of taking all the standards together, taking a structure-wise, 3 standards, 4 standards, and covering all these things. And CARO 2020 is in another area, which is all the chartered accountants are burning their midnight oil related to studying that concept. That's not only we are all work-up call is there, everybody is just look into the matters relating to the disclosures. Apart from this, the CARO 2020, the audit trail, that has been moved to the next year. That is also in another area which how an auditor can react on this. What is a subsequent event? That's a very interesting point which you are all going to debate. You are going to give a lot of feedback to everyone. Subsequent event with an auditor's signature on the audit report. That's very important. So now we have to be very clear in our thought process. What is a subsequent event? How it is going to affect the audit profession? So it may be affect the corporates. There is only a disclosure for them, but how we are going to report to the other stakeholders, that's very important aspect. And another interesting point relating to the subsequent event, sometimes we have seen that the growing phenomena of resignation of chartered accountants. That corporate law committee is very clearly mentioned that in case if a chartered accountant is resigning from a company as a statutory auditor, not only just resign on a personal reason, they have to give all the reasons for resigning. So it may be a subject to scrutiny by the regulatory authorities like MCA, even a regulatory authority of ICA, they can scrutinize why you are resigning suddenly. That too at the later date. So that will be in future, that's going to be a very important point which the auditor has to consider it. So once you complete your audit, and your audit reports are going to come. There may be a lot of queries, maybe you have to do your own report based on different judgments. But finally, if there is anything which is violated related to your disclosure, you are not giving a proper disclosure, it has a lot of impact on the firm. Not it's only originally it is the firm can just send a letter to the institute stating that so and so is in charge, is an answerable for all the queries relating to the institute queries. But today it's not like that. Institute can ask for other partners also. So it's a better, we have to deal every case in a proper manner. Every standard, it's a Bible for all of us. It's a Gita for all of us, Quran for all of us. We have to read together, debate it, discuss it, jot all the points before starting your audit. I'm very happy to see that some experts are going to give you a overall picture first. They may give you an in-depth study about a particular aspect. I've seen that very long back, a book published by our institute relating to the practical training program and case studies. I hope that institute, our chairman will take it up. The practical studies also may come in future for the purpose of debate and discussions, so that the small and medium practitioners will get more benefit out of it. I am very much thankful to the chairman and all of you for this patient hearing. And once again, I wish all you have a best discussions and debates, and bring out a best out of the speakers and use it for our professional development. Thank you very much.
Thank you so much, sir. Thank you so much. And the way you summarize the CLC report also, because you were one of the key people, who was involved in this report. So you could give.
Thank you, sir.
Relating to the case studies also, we will see that how best within the ambit of AASB we can do it. And sir, we are also now, in the process of coming out with a checklist for auditing standard for the practitioners.
Good.
And on the audit trail also, we are preparing a guidance. We are also working on the project called expectation gap, that how to bridge the expectation gap between what the auditor think their scope of responsibilities is and what the society and the government think, to what extent it can be bridged. So we are working on that as well. So certainly we'll keep in mind your valuable suggestion. Thank you so much, sir. Thank you.
Thanks.
And with this, I will now request Amit to kindly start his deliberation.
Respected Chairman CA Dr. Sanjay Kumar Singhal, Vice Chairman CA Vishal Doshi ji, Honorable Past President and Keynote Speaker CA G Ramaswamy ji, my fellow speaker CA Raisuddin Saifi, and to all the members who have joined virtually for this VCM, Namaskar, hello and good evening to all of you. Friends, it's my pleasure to be with you this evening to make a presentation on Essay 210 on agreeing the terms of audit engagement and Essay 560 on subsequent event. Before I begin my presentation, I would like to thank the AASB of ICI for giving me an opportunity to deal with this subject, be here and make this presentation virtually. Since we have limitation of time and my presentation would be followed by the presentation of my fellow speaker, so without further ado, let me begin the presentation on two very important standards on auditing, as Mr. G. Ramaswamy mentioned. Friends, as you are aware, unlike the compliance of accounting standard, where the responsibilities are shared with the management, so there is a joint responsibility of the auditor as well as the management, so far as the compliance of the accounting standard is concerned. However, when we talk about the standards on auditing, they are the sole responsibility of the auditor. Auditor is expected and also required to comply with the applicable standards on auditing while discharging his duty as an auditor. Whenever we take up any audit assignment, there are always stages in which the audit work is carried out, like planning phase, execution phase, and the completion phase. So there is always a complete life cycle. And these are the different stages of audit life cycle, like planning, execution, completion phase. And we have got different ASAs, standards on auditing, dealing with different stages of audit assignment and also dealing with different aspects of audit. These standards on audit guide auditors regarding the documentation part, the audit processes or the procedures which they need to follow while doing the audit assignment. So far as standards on auditing 210 is concerned, which I'm going to take up first, this standard generally deals with the pre-execution stage of the audit. However, it also gives guidance as regards certain situations which may arise during the course of the audit, which we will see as we go along. As the name of the standard suggests, agreeing the term of the audit engagement with the management is a precursor or the first and foremost process and an important process to be followed by the auditor before he actually begins his audit. It establishes the agreement or the understanding between the two parties, which is auditor and the management, as regards the scope of the audit, how the audit would be conducted, what would be the deliverables and the responsibility of the auditors, and as well as of the management. What would be the preconditions for the audit? So the typical engagement will also encompass the preconditions for the audit, which we are going to discuss in our presentation. And all these agreements between the two parties have to be codified in the audit engagement letter or an executable agreement. Now, with this background in mind, let me see and visit this standard through my PowerPoint presentation. Let me share my screen. So let us have the overview of SA 210, agreeing the terms of audit engagements. So what we are going to cover today, I hope all are able to see my presentation. Right, you are able to see my presentation?
No, Amitji, I think you need to reshare.
So can you see it now?
Yeah, now it's visible. Yeah.
Yeah. So friends, what we are going to cover in this SA 210, agreeing the terms of audit engagements. So we are going to visit the scope of this standard. What is the effective date from which this standard is applicable? The objective of this standard, the requirements which are envisaged in this standard. What are the preconditions for audit? This is a term which is very typical to this particular standard. So which we are going to understand what is the meaning of preconditions for an audit. Agreement on the audit engagement terms between the two parties. Recurring audit, what happens in case of a recurring audit, whether I need to again exchange the audit engagement letter or not. So we are going to see those conditions. Then acceptance of a change in the terms of the audit engagement. What happens if there are changes in the terms of audit engagement during the terms of audit or during the subsequent years. And we'll also see additional considerations in for engagement acceptance. Friends, this SA 210 is effective for audits of the financial statements for periods beginning on or after 1st April 2010. This particular essay deals with the auditor's responsibilities in agreeing the terms of the audit engagement with the management and where appropriate, those charged with the governance like board of directors or audit committee in case of a listed companies. Now, what is the main objective of this particular standard? The main objective of this particular standard is to establish whether the preconditions for an audit are present. And number two, confirming that there is a common understanding between the auditor and the management or those charged with the governance of the terms of the audit engagement. So there are twin requirements. First of all, whether there are preconditions which are present or not, and confirming that there is a common understanding between the two parties on the terms of the audit engagement. Now, let us understand what is precondition for an audit. The precondition for an audit is the use by the management of an acceptable financial reporting framework in the preparation of the financial statements and the agreement of the management and where appropriate, those charged with the governance to the premise on which the audit is conducted. So the precondition of the audit would be that use by the management of the acceptable financial reporting framework. And we'll see what are those acceptable financial reporting framework in the next bullet point. Now, friends, if you see SA 200, it defines applicable financial reporting framework, and it says that the financial reporting framework adopted by the management and where appropriate, those charged with the governance in preparation and presentation of the financial statements that is acceptable in view of the nature of the entity and the objective of the financial statements or that is required by the lower regulation. So friends, this acceptable financial reporting framework depends on many factors like the nature of the entity, whether the entity is a corporate or a company or LLP or a partnership firm, whether there is any regulation which specifies the financial reporting framework or not, So say for example, in case of a company, we have got a framework of company's accounting standard rules. We have got company's Ind AS rules. Then we have got a schedule 3, which gives the reporting requirement or the disclosure requirements or the presentation requirements. So it depends from entity to entity. And so in case of a company, if say for example, the accounting standard rules are applicable to that entity, then the financials will be reported based on the accounting standard regulations. Then in order to establish that the preconditions for an audit are present, the auditor shall determine whether the financial reporting framework to be applied in the preparation of the financial statements is acceptable or not, and also obtain the agreement of the management that it acknowledges and understands its responsibility with regard to the preparation of the financial statements in accordance with the applicable financial reporting framework, and for such internal control as management determines is necessary to enable the preparation of the financial statements that are free from material misstatement, whether due to fraud and error. So the management has to also acknowledge that it is going to follow the acceptable financial reporting framework. At the same time, they will also acknowledge and understand their responsibility with regard to such installation of internal controls which are necessary for the purpose of preparation of financial statements. Those are free from material misstatements. The management has to also agree to provide the auditor with access to all the information of which management is aware and that is relevant to the preparation of financial statements, such as records, documentation, and other matters. Because unless and until all this information is not made available to the auditor will not be in a position to give his opinion on the true and fairness of the financial statements, and which may bring certain limitations to the scope of his audit. Then management has to also provide the auditor with certain additional information that the auditor may request from the management for the purpose of the audit. And for the purpose of consolidated financial statements, this would include the management of the subsidiaries, associates, and joint ventures of the entities which get consolidated. So say for example, if the auditor is doing the audit of a particular standalone entity, then it would include the information from the management. However, if the auditor is doing is issuing the audit report on consolidated financial statements, then he would also like to seek information from the management of the components which are getting consolidated in the financial statements, consolidated financial statements. Then auditor would also require the unrestricted access to the persons within the entity from whom the auditor determines it is necessary to obtain an audit evidence. So in order to discharge his audit function, auditor needs unrestricted access to all the persons within the entity from which the auditor feels that he would like to seek information or audit evidence. Now, what are the factors which affects the acceptability of the financial reporting, fair reporting framework? Now, factors that are relevant to the auditor's determination of the acceptability of the financial reporting framework to be applied in the preparation of the financial statements are, because friends, what happens is that, say for example, the management says that to them the company's accounting standard rules framework is applicable. But if in the opinion of the auditor, it is the company's Ind AS accounting standard rules are applicable, then it will be a completely different financial reporting framework. So for this purpose, these are the factors which affect the acceptability of the FRF. So auditor will have to assess the nature of the entity. For example, whether it is a business enterprise or not-for-profit organization, the purpose of the financial statements. For example, whether they are prepared to meet the common financial information needs of the wide range of users. So it means general purpose financial statements or the financial information needs of the specific users. So then it will be a tailor-made financial statements to meet the needs of the specific users of the financial statements. The nature of the financial statements. For example, whether the financial statements are complete set of financial statements or single financial statements, and whether law or regulation prescribe the applicable reporting framework or not. So say for example, like I mentioned before, and I am reiterating again, that in case of companies, there is an applicable reporting framework given under the Companies Act. Now friends, if the preconditions for an audit are not present, then the first step would be the auditor shall discuss the matter with the management, and unless required by the law or regulation to do so, the auditor shall not accept the proposed audit engagement if the auditor determines that, or if it comes to the conclusion that the financial reporting framework to be applied in preparation of the financial statement is unacceptable to the auditor. If there is any disagreement between the auditor and the management regarding the applicable financial reporting framework, then he will not accept the engagement, because we are talking about the planning or first phase of the audit. And at that time, the execution of audit has not commenced. So at the initial stage of the audit only, at the time of discussion with the management only, both the parties have to agree on the acceptable financial reporting framework. And it has to be codified in the audit engagement letter. Or if the agreement of the management acknowledged referred to above has not been obtained. So if the management expressly do not acknowledge that what are their responsibilities in conducting the audit, then auditors will not accept the audit engagement. Now, friends, what happens when sometimes the limitations are placed by the management on the scope of the audit? Now, say for example, if the management or those charged with the governance impose certain limitations on the scope of the auditor's work in terms of the proposed audit engagement, and such that the auditor believes that the limitation will result in disclaiming an opinion on the financial statements, then the auditor shall not accept such limited engagement as an audit engagement unless required by the law or regulation to do so. So friends, what can be the example of such limitations being placed on the scope of the audit? So say for example, if the inventory verification is one of the important procedure to be followed by the auditor, and also, the balance confirmation is again an important audit procedure which the auditor follows to confirm that the assets, the creditors or debtors are stated in the financial statements agree with the confirmation received. So this is a very important audit procedures like inventory verification, balance confirmation. And if the management does not allow the auditor to at the counting of the inventory, or does not give access to the auditor to send confirmation request, and if the auditor determines that he will not be able to follow other procedure to confirm the existence, and he feels that if he comes to the conclusion that then he will have to give the disclaimer of an opinion, then at the first place only he will decline the engagement. He will not go ahead with the engagement. Now, like I mentioned before, once the management and the auditor agree on the terms of the audit, then these terms or these terms will have to be codified in the form of audit engagement letter. And what are the main ingredients which are must for an audit engagement letter? So let us see those. The typical audit engagement letter would include the objective and the scope of the audit of financial statements, the responsibility of the auditor in conducting the audit, the responsibility of the management in providing the information to the auditor so that it helps the auditor to conclude his audit and give his opinion, identification of applicable reporting framework. So this engagement letter will also mention the framework which the auditor is going to use for auditing the financial statements, and based on this, the report will be given by the auditor. And any reference to the expected form and content of any report to be issued by the auditor. So say for example, if in case of a company, audit report on internal financial control is also applicable, then auditor will have to also mention in his engagement letter that auditor, along with the normal audit report, he will have to also issue the audit report on internal financial controls. Now friends, there is always a discussion regarding the recurring audit, whether the auditor needs to obtain the audit engagement letter every year. Now, friends, in case of a company, as you all are aware, the appointment term is now for 5 years under the Companies Act 2013. Now, even under Companies Act 2013, earlier there was a clause for ratification of auditor's appointment every year. Now that provision regarding auditor's ratification is being done away with. So now the appointment is for a term of 5 years. Now, say for example, once the auditor is appointed for a term of 5 years, whether he needs to obtain the audit engagement letter on a year-on-year basis, or whether the audit engagement letter which he has obtained at the beginning of the appointment term, whether that would suffice. So now, to help him navigate and help him decide whether he needs to obtain any new engagement letter or whether he needs to revise the engagement letter, these are following are the factors which make it appropriate to revise the terms or to remind the entity of the existing terms. So these are the factors, like any indication that the entity misunderstands the objective and scope of the audit, any revised or special terms of the audit engagement, any recent change in the senior management. So say for example, if there are recent change in the senior management and the auditor wants to appraise the new management about the terms of the audit engagement, then he may think of issuing a new or the revised audit engagement letter. If there are any significant change in the ownership of the entity, it may warrant a new audit engagement letter. A significant change in the nature or size of the entity's business, a change in the legal or regulatory requirements. So like I mentioned before, say for example, if the earlier the entity was covered under accounting standard rules, but now the entity has migrated to Ind AS rules. So then it will necessitate change in the engagement letter, and the auditor will have to exchange a revised or updated audit engagement letter with the management. Now friends, this engagement letter, once original engagement letter is executed with the management, in the subsequent years, there can be a couple of possibilities, like the auditor may think of updating the audit engagement letter based on the factors which are listed in front of you, or he may issue the addendum so that the management agrees with the additional points which the auditor has proposed to be agreed upon, and change in any other reporting requirements. So the auditor shall not agree to a change in the terms of the audit engagement when there is no reasonable justification for doing so. Some of the reasonable justification are change in the circumstances affecting the entity's requirement and misunderstanding as to the nature of the audit. So say for example, if during the course of the audit, if the management comes out with some new terms of audit engagement, and if the auditor feels that these new terms are not justifiable, then he will not accept those terms. If before completing the audit engagement, auditor is requested to change the audit engagement to an engagement that conveys lower level of assurance, then auditor shall determine whether there is a reasonable justification for doing so or not. So say for example, if during the course of the audit engagement, management restricts scope for certain aspects of the audit like inventory verification or the balance confirmation, or if the management requests the auditor to convert the audit engagement into review engagement, then he will have to determine whether there is a reasonable justification for doing so. If he feels that it is not reasonable, then he will withdraw after discussing it with the management. And friends, there is very important point here that if the auditor decides to withdraw from the engagement, then you will have to also keep in mind the relevant rules and regulations of the act which regulates the entity. So say for example, in case of a listed entity, there is a Companies Act which has got certain requirements for the auditor's resignation. There is also SEBI guidelines which stipulates that what is the procedure to be followed by the auditor when he resigns. So there is a clear-cut guidelines by the SEBI. So you will have to keep those guidelines in mind before he withdraws from the engagement. And then let us understand what are the additional considerations in the engagement acceptance, which the auditor has to keep in mind. When the audit report is prescribed by law or regulation, then he will have to evaluate whether the users might misunderstand the assurance obtained from the audit of the financial statements, and if so, whether additional explanation in the audit report can mitigate possible misunderstanding. So say, for example, the very immediate example which can come to our mind is the form 3CA, 3CB. So again, if you see the structure of form 3CA, 3CB, which is the audit opinion on tax audit. Now, if the structure of the audit report in 3CA, 3CB is governed by the Income Tax Act and the rules issued thereunder. Now, that format is not strictly in compliance with AS 700. So in that case, the auditor has to determine that whether he needs to put certain paragraphs so that there are no misunderstanding by the users of the financial statements or users of the tax audit report. So if you refer the guidance on the tax audit for 2014 edition, it gives certain paragraphs which the auditor needs to put in the tax audit report about the auditor's responsibility, about the management's responsibility, because per se in the audit report format of 3CA, 3CB, these are not covered. So auditor will have to keep all these requirements in mind. Now friends, Institute has come out with an implementation guide on SA 210. It is a very beautiful publication. Initially it gives the overview of the standard, then it goes along with the question and answer format, and it also gives certain pointers or certain contents which can form part of the audit engagement letter. And I would request all the members which are right now joining me on this virtual CP meeting to go through this excellent publication from AASB on implementation guide on SA 210, from which they will be able to identify many points which may not be there in their engagement letters. So when we are going to start the audit for this particular year, we can incorporate those pointers or those contents from the implementation guide, and we can make our engagement letter wholesome and more comprehensive so that it covers us also and it covers all the bases of the audit. Now, what would be the typical contents of the audit engagement letter? The audit engagement letter generally will start with a reference to the appointment letter which the auditor has received from the management. So the auditor will refer to that appointment letter as a recital. Then the engagement letter will also give the reference to the period of the financial statements. So the financial statement, beginning of the financial statement and the end of the period of the financial statements. Now, it will also give the reference of the contents of the financial statements, like consolidated financial statements, even in financial statements like balance sheet, P&L, cash flow statements, statement of changes in equity, etc., etc. Then it will also give reference to the objectives of the audit, the elaboration of the scope of the audit, including reference to applicable legislation, regulations, standards on auditing, and ethical and other pronouncement of the professional bodies to which the auditor adheres. Reference to reasonable assurance and not a guarantee. Friends, this is very important point. Each and every engagement letter should have this particular point so that there are no misunderstanding from the management. So the auditor always gives a reasonable assurance, which is also high quality assurance, but it is not an absolute guarantee that there will not be any material misstatement in the financial statement. So this particular point has to be there in the audit engagement letter, that the auditor's report will result in a reasonable assurance on the financial statements and not an absolute guarantee. The reference to the responsibility of the auditor. So it will also give the responsibility of the auditor. It will mention that the auditor will conduct the audit in accordance with the standards on auditing specified under the Companies Act and how he is going to carry out the audit. Reference to the reporting to central government under section 143(12) relating to the fraud. Friends, as an auditor, we are supposed to maintain the client confidentiality, and the information which we have gathered during the audit, it remains confidential with us. However, in certain situations, if the auditor detects any fraud or he has reason to believe that there is any fraud which has happened in a particular entity, then he may have to report to the person who are charged with the governance and the central government also. So there has to be a clear recital in the audit engagement letter that if such kind of situation arises, then he will have to report the findings to the central government. Then auditor under section 143.10, the auditor has got certain responsibility for the other information, and he has to mention that in his auditor's report. There is also particular standards on auditing 720 on auditor's responsibility relating to other information. So the auditor will clearly mention in the engagement letter that they would be making requests to the management to share with them the annual report once the audit is completed, and the auditor will see whether there are any inconsistency between the annual information, other information given in the annual report, and the information which is contained in the financial statements and the auditor's report. Then a reference to the expected form and content of any report to be issued by the auditor. The requirement for the auditor to communicate key audit matters in the auditor's report in accordance with 701, communicating key audit matters. So the auditor, if there is a listed entity and auditor feels that auditor, in any case, the auditor is required to give the CAN, but this has to be clearly mentioned in the audit engagement letter that the auditors will be giving the key audit matters in their audit report. It will also mention that the fact that because of the inherent limitations of the audit together with the inherent limitations of the internal control, there is an unavoidable risk that some material misstatement may not be deducted even though the audit is properly planned and performed in accordance with SS. So this paragraph should also be featuring in our audit engagement letter. The agreement of the management to inform the auditors of the facts that may affect the financial statements of which the management may become aware during the period from the date of the auditor's report to the date of the financial statements are issued. So if the management becomes aware of any subsequent events, then they will promptly notify the auditors regarding them, and they will discuss with the auditors, and they will come to a conclusion that whether any adjustment to the financial statement is required or not. But the auditor will be given the details of such subsequent events. So this request has to be made in the engagement letter itself. Reference to reliance of any other auditors, if any, like the branch auditors, other experts. So the auditor will mention in the engagement letter that during the course of the audit, they may rely on the reports of the branch auditors. They may take the help of other experts or not. Reference to the matters to be communicated to those charged with the governance. Now, there may be certain, if during the course of the audit, if he finds certain important findings, which he feels, which he comes to the conclusion that he needs to make those charged with the governance aware about those facts, then he will communicate those matters with the person who are in the capacity of board of directors or the audit committee. Then it should also include a clause on the protective on the data transfer, work papers. Now, friends, work papers during the course of the audit, the auditor accumulates many work papers. He generates many work papers. So these work papers are sole property of the auditors. And auditor will have to be clearly mentioned to the client in the engagement letter. This work paper will always remain the property of the auditors. Then he will have to also mention the requirement of generating the UDIN. For past 2 years, there is a requirement of generating UDIN whenever auditor issues any auditor's report. So the audit engagement letter will clearly mention that at the end of the audit, when the auditor issues his audit opinion, the auditor will have to generate UDIN on the site of the ICAI, for which he will require certain operational data or certain financial data, which will have to key in at the time of generating UDIN. The recital in engagement letter will have to also include how the fees would be computed, what would be the amount of the fees, how the invoices will be raised, what would be the credit period. Then this is also another important point, that now that the audit process may be subject to a peer review under the Chartered Accountants Act 1949. So say, for example, if the firm is subject to the peer review, then it will clearly mention in the audit engagement letter that since they are subject to peer review, the peer reviewer may, during the course of their peer review, examine the audit working papers and can take extract of the working papers. Then any other legal requirements like SEBI requirements regarding resignation of the auditors, statutory auditors from listed entities. So friends, this particular paragraph, in case of listed entities, this particular paragraph has to be there in the engagement letter. And I would also like to draw the attention of the members that there is also implementation guide from the institute on the resignation of statutory auditors. So please keep the requirements of the processes or the procedure which the auditor has to follow from the implementation guide along with the regulatory requirements. Then limitation on damages, confidentiality matters, reference to separate engagement letter for audit under section 143(3)(1). So friends, if a client comes under, there is a separate audit under internal financial control also. So there will be twin audit reports, one for the normal audit and one for the audit on internal financial controls. Now, the audit engagement letter format for internal financial control audit is given under the guidance note on internal financial controls. So auditor can very well take the format from there, and he will have to also execute a separate engagement letter for audit of internal financial controls. And both these engagement letters, one for main audit and one for IFC audit, will give the cross references of the individual engagement letters. And lastly, there will be a request for the management to acknowledge the receipt of the audit engagement letter and to agree to the terms of the engagement outlined therein. So normally the audit engagement letter, the last paragraph of the audit engagement letter will give the request to the management that please acknowledge the receipt of this engagement letter and please sign at the particular places, so that we understand that you are acknowledging and you are understanding the requirements of the audit. Now, having understood what are the contents of the audit engagement letter, let us understand with whom should the terms of the audit engagement be agreed with. The terms of the audit engagement would have to be agreed with the management or those charged with the governance as appropriate, like board of directors or audit committee as the case may be. In the case of companies, like I mentioned, AC or board of directors. In case of a partnership firms, the terms need to be agreed with the partner of the firm. In case of trust, it will be trustees, and so on and so forth. Now, this is also a very important question sometimes which arises, whether the engagement letter has to be mandatorily countersigned by the management of the entity or not. Friends, normally we should take the engagement letter countersigned by the management, which should be our audit procedure only. However, there is a general clarification issued by the AASB on SA 210, which states that the auditor and the client are normally considered to be agreeing on the terms of the engagement if the objective and the scope of an audit and auditor's obligations are laid down in the statute or the regulations governing the engagement. In such cases, it is not necessary that the engagement letter sent to the auditor is acknowledged by the addressee and returned to the auditor to establish that the client understanding of the terms of the engagement is in accordance with the engagement letter. However, it shall be sufficient compliance with the requirement relating to sending the audit engagement letter if an engagement letter is appropriately delivered to the client and the auditor retains the evidence for such delivery. So in such cases, the engagement letters would be informative for the clients. So say, for example, like such engagements would include audit under 139 of the Companies Act, audit of public sector banks also, because the Companies Act clearly codifies the responsibilities of the auditor, responsibility of the management. So if the management does not sign, it is fine, but the auditor needs to have the evidence that it has shared the engagement letter with the management and it has got the proof of sharing the engagement letter. However, in all cases, we should endeavor to get the signature of the management on the audit engagement letter, because it is like an agreement between the two parties. Now, let us take few questions at this juncture. Who can sign the engagement letter on behalf of the firm, audit firm? the engagement letter need to be signed by the partner or the proprietor of the firm. So in case of a partnership form of chartered accountants, it can be any partner who can sign the engagement letter on behalf of the auditee. This is very important. The engagement letter needs to be acknowledged by the appropriate level of management who have been conferred the powers of board of directors in case of companies. In case of partnership firms or LLP, it can be by the partner. So again, reiterating that in case of a company, it will be the appropriate level of authority to whom the powers have been given by the board of directors. Now, another question which arises is, in case more than one auditor are appointed to conduct the audit jointly and report on the financial statements of the entity. So say, for example, there are joint auditors in a case of a particular company. So whether both the auditors should have individual separate engagement letters with the management, or it can be a joint or common engagement letter. So again, if you see the implementation guide on SA 210, it says that joint audit of the financial statement, the joint auditor shall obtain common engagement letter. So it will be like a tripartite agreement. Should a separate engagement letter be sent to component when the auditor of the parent entity is also the auditor of the component? So now, friends, when we talk about component, it can be a branch or it can be a subsidiary also. So let us understand whether there is a separate engagement letter needs to be sent to a component or not. Now it says that when the auditor of a parent entity is also the auditor of the component, the factors that may influence the decision whether to send a separate engagement letter to the component include the following: who appoints the component auditor, whether a separate auditor's report is to be issued on the component, legal requirements in relation to the audit appointments, degree of ownership by parent, degree of independence of the component management from the parent entity. So friends, so far as if you see the Companies Act 2013, so far as subsidiaries are concerned, I would tend to feel that there has to be a separate engagement letter for the subsidiary. With this, we come to the end of our presentation on SA 210. Because we are running slightly late, I would straight away jump to the next standard on auditing, 560, on subsequent events. So what is the scope of this particular standard on auditing? This essay is effective for the audit of the financial statements for the period beginning on or after 1st April 2009. This particular essay deals with the auditor's responsibility. So friends, whenever you see the scope of auditor under any standard on accounting, it states auditor's responsibility. The scope would always deal with auditor's responsibility relating to that particular standard on auditing. So in case of this particular standard, this essay deals with auditor's responsibility relating to subsequent events in an audit of financial statements. It does not deal with matters relating to auditor's responsibility for other information obtained after the date of the auditor's report, which are addressed in essay 720 revised. Having understood the scope of this particular standard, let us understand what are the objectives of this particular standard. So friends, there are twin objectives of this particular standard. They are obtaining sufficient appropriate audit evidence about whether events occurring between the date of the financial statements and the date of the auditor's report that requires adjustment of or disclosure in the financial statements are appropriately reflected in those financial statements or not. So friends, we are already aware about AS 4 on events occurring after the balance sheet date, Ind AS 10. Now this first limb is akin to the requirements of AS 4. Then the next limb is respond appropriately to facts that become known to the auditor after the date of auditor's report that, had they been known to the auditor at that day, may have caused the auditor to amend the auditor's report. So say, for example, if certain facts come to the light of the auditor after the date of auditor's report, which if those facts would have come to the light earlier, then auditor would have changed his audit opinion. Then he will have to take care of these facts under this particular standard. Now, let us understand what is the definition of subsequent events under this particular standard. It means events occurring between the date of the financial statements and the date of auditor's report, and facts that become known to the auditor after the date of auditor's report. So now, friends, if we see AS4, let us for a moment understand the interplay between AS4 and SA 560. Now, SA4 gives the guidance regarding existing event or non-existing event and its implications in the financial, whether it requires any adjustment of asset or liability in the financial statements or not, from the date of the balance sheet till the date the financials are approved by the board of directors. So it covers this particular period. Whereas the subsequent events as defined under this particular standard have a broad meaning and have a wider implications and ramifications. It not only covers the period between the date of the financial statements and the date of approval of the financial statements, but it also covers the period ranging from the date of the audit report till the date of financial statements are issued. We'll come to know what is the meaning of the date of financial statements issued. Now, it also talks about date of approval of the financial statements. So friends, we all know the date of financial approval of the financial statements in case of a company would be the date on which the board of directors approve the financial statements. What is the date of the auditor's report? The date of the auditor report is the date which he puts on the audit report, the date on which he has completed the audit. Now, what is the meaning of the date financial statements are issued? And this is very important, friends. So far under AS4, we know that what is the date on which the financial statements are approved, which is the board meeting where the financial statements are approved before they are sent to the members at the AGM. Now, under this particular essay, the date of the financial statement issued means the date that the auditor's report and the audited financial statements are made available to third parties. It means it goes to the public domain. Now, let us understand what is the meaning of third parties. Third parties would indicate a wide range of stakeholders like bankers, shareholders, etc. So, if you see the implementation guide on SA 560, again here also the AASB has come out with the implementation guide to help the members deal with implementation issues of this particular standard. So it gives 3 scenarios. In case of listed entities, the date of submission of results to the stock exchange will be considered as the date of financial statements are issued, irrespective of when the notice calling the annual general meeting, board report, and the full set of financial statements with all the notes and disclosures are subsequently issued to the shareholders. So in case of listed entities, it will be the date on which the financial statements are shared with the stock exchange. There can be, in case of non-listed entities, the date the financial statements are issued could also be the date when the auditor's report and the audited financial statements are provided to any third party, or in all other cases, it can be the date the financial statements are issued when the notice calling the AGM is sent to the shareholders along with the board report and the auditor's report and the audited financial statements. So when the notice calling the AGM along with the meeting documents like complete set of documents like board report, auditor's report, complete financial statements are sent to the members along with the notice, it will be the date, it will deem to be the date when the financial statements are issued to the third party. Now friends, while applying this particular standard on auditing, it is incumbent upon the auditor to make certain inquiries into subsequent events. Now, given below is a list of certain events which can trigger subsequent event review by the auditor. Like there have been new commitments, borrowings or guarantees that have been issued or that have been entered, invocation of force majeure clause after the year end by any party, recent or planned sales or acquisition of assets, impact on realizable value of inventory of a short-term nature, implication of impairment in the value of investments or impairment of any other assets for that purpose, assets appropriated by the government or assets destroyed by fire or flood, developments regarding contingency. So earlier there was a contingency, but now it has turned into a full-fledged provision. So auditor will need to assess the impact. Unusual accounting adjustments are contemplated by the management, so that can also trigger the subsequent event review. Now, there are 3 different situations which are envisaged under SA 560. These are events occurring between the date of the financial statements and the date of the audit report. Second one being facts which become known to the auditor after the date of the auditor's report, but before the date the financial statements are issued. And the third would be facts become known to the auditor after the date of auditor report, but after the date the financial statements are issued. So in the second scenario, it is after the date of the audited report, but before the date the financial statements are issued. In the third scenario, it is between the date of the auditor's report and after the date the financial statements are issued. Or rather, I would put it simply, it is after the date the financial statements are issued. Now let us discuss for a few minutes on scenario number 1. Events occurring between the date of the financial statements and the date of the auditor's report. In this scenario, the auditor shall perform audit procedure designed to obtain sufficient appropriate audit evidence that all events occurring between the date of the financial statements and the date of the auditor's report that require adjustment or disclosure in the financial statements have been identified. The auditor will obtain an understanding of any procedure management has established to ensure that subsequent events are identified. Inquiring of the management or those charged with governance that any subsequent events which have occurred which might affect the financial statements. So he will have to inquire, he will have to take the understanding from the management about the processes which the management have designed to ensure that they come to know about the subsequent events. Then auditors can read the minutes of the meetings of the shareholders, management, those charged with the governance that have been held after the date of the financial statements, and inquiring about the matter discussed at such meetings for which the minutes are not yet available. So he will have to go through the minutes, and if the minutes are not available, then he will have to discuss about these matters with the management. And in this case, he may obtain suitable written representation from the management. And he may also read the entity's latest subsequent interim financial statements, if any. Now, when as a result of the audit procedure performed, the auditor identifies any event that requires adjustment or disclosure in the financial statements, the auditor shall determine whether such event is properly reflected in those financial statements or not. So under this standard, it is incumbent, it is required of the auditor that once he identifies that there is a particular subsequent event which requires any adjustment or which requires any disclosure, then they will perfectly, appropriately reflect in these financial statements. The auditor shall also request management and those charged with the governance about written representation that all events occurring subsequent to the date of the financial statements and for which the applicable financial reporting framework requires adjustment have been adjusted or disclosed. Now, friends, let us come to the second scenario where the facts become known to the auditor after the date of the auditor report, but before the financials are issued to the stakeholders or to the third parties. Now, in this scenario, generally, the auditor has no obligation to perform any audit procedures. However, when the date of the auditor's after the date of the auditor's report, but before the date of the financial statements are issued, a fact becomes known to the auditor. Had it been known to the auditor at the date before the auditor's report, may have caused the auditor to amend the auditor's report. The auditor will follow 3 steps, which is discuss the matter with the management. He will determine whether the financial statements need any adjustment. He will also inquire how the management intends to address the matter in the financial statements. when the law regulation of the financial reporting framework does not prohibit the amendment of the financial statements. So say for example, if management and the auditor comes to a conclusion that there is a subsequent event which requires adjustment in the financial statements, then what they will do? Now, if the law or the regulation allows revision or the amendment of the financial statements to give the effects of the subsequent events, then the auditor shall either amend the auditor's report to include an additional date restricted to that amendment, that thereby indicates that the auditor's procedure on subsequent events are restricted solely to the amendment of the financial statements described in the relevant note to the financial statements. So friends, in this particular case, what is important is the additional date. Now, auditor has already dated the original audit report. However, since a particular subsequent event has come to the notice of the auditor and which requires any change in the financial statements, so auditor will put additional date and he will refer to those changes in the financial statements. He will refer to a note in the financial statements in this particular additional note. So there will be twin dates in this particular audit report. Then he has got another alternative, which is provide a new or amended auditor's report that includes a statement in an emphasis of matter paragraph or other matters paragraph that conveys that the auditor's procedure on subsequent events are restricted solely to the amendment of the financial statements as described in the relevant note to the financial statement. So here he has got two options. Either it goes for additional date in the auditor's report, whereby he will amend the auditor's report, or provide a new auditor's report or amended auditor's report in which he will place an UOM paragraph or other matter paragraph as the situation demands, and where he will refer to this particular subsequent event. Now friends, I have already explained in the earlier slide about what is the meaning of dual dating. Again, let us recapitulate that. When the auditor amends the auditor report to include an additional date restricted to the amendment of the financial statements by the management, the date of the auditor's report on the financial statements prior to their subsequent amendment by the management remains unchanged. So the earlier date remains the same because this date informs the reader as to when the audit report on those financial statements was completed. So it is the original date when the audit was completed. However, an additional date will be included in the auditor's report to inform the users that the auditor's procedures subsequent to that date are only and only restricted to the subsequent amendment of the financial statements. Now, this illustration of dual dating can be like this. Date of the, so this, the bracket, into bracket, the original date will come, except as to note number so and so, which is as of the subsequent date. So this is known as dual dating. Now, if the management does not agree to the amendment, or if the law does not allow to amend the financial statements, then what is the course of action? If the auditor's report has not yet been provided to the entity, then the auditor shall modify the opinion as required under 705 revised and then provide the auditor's report. So if the auditor has not provided the audit report to the management, then he will, because the management is not amending the financial statement, which in the opinion of the auditor should be amended, then he will give the modified opinion in terms of SS 705 revised. However, if the auditor's report has already been provided to the entity, the auditor shall notify the management not to issue the financial statements to the third party before the necessary amendments have been made. If the financial statements are nevertheless issued without the necessary amendments, the auditor is required to take certain appropriate action to seek to prevent the reliance on the auditor's report. We will see those in the subsequent slide. Which is, what is the action required to be taken by the auditor? It is like notification to the client that auditor's report should no longer be associated with the financial statements, notification to the regulatory agency having jurisdiction over the client that auditor's report should no longer be relied upon. So in case of a company, it can be SEBI. In case of a listed company, it can be SEBI. In case of a non-listed company, it can be ROC. Notification to each person known to the auditor to be relying on the financial statements that his report should no longer be relied upon. Now, generally, the auditor should inform all the stakeholders. However, in many instances, it may not be practicable for the auditor to give appropriate individual notification to the shareholders or the investors at large. In such case, he can give notification to a regulatory agency having jurisdiction over the client, which will be the only practicable way for the auditor to provide appropriate disclosure. So he will inform the regulatory authority, and such notification or such information to the regulatory authority should be accompanied by a request that this regulatory authority take whatever steps it may deem appropriate to accomplish the necessary disclosure, which would typically be by way of a press release or some kind of advertisement or so. The auditor may consider seeking legal advice also on the matters, including those relating to provisions under the Companies Act 2013. And one important aspect which is also worth importance is revoking the UDIN. Since auditor now says that his audit report should not be placed reliance upon, then he is required to revoke the UDIN. And he will also notify the relevant authorities. Now, this is the pictorial mentioning of the this particular scenario. Now, let us go to the third scenario. Facts which become known to the auditors after the financial statements have been issued. Now, in this particular case, when after the financial statements have been issued, a fact becomes known to the auditor that had it been known to the auditor at the date of the auditor report, cause the auditor to amend the audit report, then again the auditor will follow the same steps which we have seen in scenario number 2. He will initially discuss the matter with the management. He will determine whether the financial statements need to be amended or not. He will also inquire how the management is going to address this particular matter. If the management amends the financial statements, then auditor will do the following steps. He will carry out the audit procedures necessary in the circumstances on the amendment. He will also review the steps taken by the management to ensure that anyone in the receipt of the previously issued financial statements together with the audit report thereon is informed about the situation. Because in this particular third scenario, the financial statements have already been issued. They are already in the public domain. So he will like to understand what are the steps which the management is taking to ensure that this auditor's report is not relied upon by the public at large. He would also like to extend the audit procedure to the date of the new auditor's report and date the new auditor's report no earlier than the date of approval of the amended financial statement. So if there are amended financial statements, obviously they would be on the subsequent date. And in that case, the amended auditor's report or the new auditor's report would be of the same date. It cannot be earlier than that. Now, in this particular audit report, there will be a EOM paragraph or the other matter paragraph referring to a note to the financial statements that more extensively discusses the reason for the amendment of the previously issued financial statements and to the earlier report provided by the auditor. If the management, say for example, if the management does not take any necessary steps to ensure that anyone in the receipt of the previously issued financial statement is informed and does not amend the financial statements where the auditor believes they need to be amended, the auditor shall notify the management or to those charged with the governance that auditor will seek to prevent the future reliance on the auditor report. If despite such information, despite such notification or request, the management or TCWG do not take any necessary steps, the auditor will take appropriate steps to prevent reliance on the auditor's report, which we have already seen in the second scenario. Again, this is a flow chart of this scenario number 3. Now, friends, what can be the UDIN implications? Say, for example, when the management amends the financial statements and new audit report is issued. Now, since the new audit report is issued, then in that case, the auditor will need to revoke the earlier UDIN and he will have to generate the new audit and then the new date of the auditor's report. And he will have to mention that particular UDIN in the new audit report. Now, in case of another scenario where management does not amend the financial statements, then he will have to ensure that the UDIN which he had originally generated is revoked by giving the reasons on the UDIN portal. Now, friends, before I conclude, I have picked up 2-3 case studies for deliberation. Case study number 1. A fire broke out on 15th May 2021, in which material worth 50 lakhs, which was lying in the inventory since 1st March 2021, was totally destroyed. The financial statements of the company have not been approved till the date of the fire. The management of the company argues that since the loss occurred in the year 2021-22, no provision for this loss is required in the financial statements. As an auditor, how would you deal with this particular scenario? Now, friends, if we look at this particular case study, this event of fire has happened after the balance sheet date. Though inventory was lying as on 31st March, however, this particular event has happened after the date of the balance sheet. Now, if we take the guidance from AS 4 or Index 10, generally this should be a non-adjusting event. However, the auditor will have to bear in mind whether it affects the going concern assumption, whether it affects the very substratum of the entity, that there is a doubt regarding the going concern assumption. If that be the case, then it would be an adjusting event. Otherwise, from the facts of the case, this would be a non-adjusting event. Auditor will have to make inquiries with the management. He will have to go through all the papers, details of the inventory, and ultimately he will have to come to the conclusion in his subsequent event review. So all these discussions, minutes and everything of this particular case will have to be documented by the auditor as a part of the subsequent event review and kept in his audit working file to come to a conclusion that this is a non-adjusting event. Let us go to the case study number 2. A company limited has not included in the balance sheet as on 31st March 2021 a sum of rupees 1.5 crores, considered to be a very material amount, being amount in the areas of salaries and wages payable to the staff for the last 2 years as a result of successful negotiations which were going on during the last 18 months and post the balance sheet date, which is on 30th of April 2021. Now, friends, bear in mind this event has occurred. These negotiations have concluded on 30th of April 2021. Now, let us read this case study further. The auditor wants to sign the said balance sheet and give the audit report as on 31st May 2021. The auditor came to know about the result of this negotiation on 15th May 2021. As an auditor, comment on the above scenario. Now, this particular scenario, if we talk about SA 560, comes under the scenario where it is an event which has happened post the balance sheet date, but before the auditor has issued his audit opinion or before the date of the auditor's report. If we take the analogy of AS4, then this scenario would fall in adjusting event because the negotiations were going on for past 2 years. Only thing, it has been fructified and it has crystallized post the balance sheet date. However, the negotiations were going on during this last 18 months. Hence, this event can be considered to be an adjusting event. Here, also AS 29 would also come into play, and the auditor will have to bear in mind the requirements of AS 29 and similar provisions of Ind AS, and he will have to request management to make suitable provisions for this in the books of accounts. And you will have to follow all the necessary procedures of inquiry, checking of documents for the subsequent event review. Now let us go to the last case study. On 20th September 2020, a customer initiated legal proceedings against the company in relation to a breach of a contract. On 29th September, the company's legal advisors informed the directors that it was unlikely the company would be found liable. Therefore, no provision was made in the financial statements, but disclosure as a contingent liability has been made. On 29th of October, the court found the company liable on a technicality and is now required to pay damages amounting to a material sum. The financial statements are for the period ended 30th September, and the annual meeting is slated on 29th November. The audit report has not yet been issued on 29th of October. Again, in this particular case, the audit report has not been issued. Now, in this particular case, there was always a situation which was there as on the balance sheet date of a legal proceedings against the company. The case was going on. Initially, the management was of the view that they are quite comfortable, there won't be any liability against the company, and hence it was only shown as a contingent liability in the financial statements. However, subsequently, based on the court order, now they are liable to period damages, and it would then become an adjusting event, and company will have to make the provisions. The auditor on his part will need to ensure that the provision is adequate. We will have to go through all the papers relating to the claim and everything. We will have to also inquire with the legal team of the company. And finally, he will have to ensure that the sum provided in the books of account is correctly mentioned. So this is the procedure. This is a adjusting event, and this also comes within the purview of SA 560. And based on this, the auditor will conclude that this is an adjusting event. So friends, with these 3 case studies, I have concluded my presentation because I am pretty sure that I have already exceeded my time, and my fellow speaker is already ready with his presentation. So if we have time for few questions, we will take up, or as the ASB team decides. So with this, I conclude my presentation, and I thank you all.
Can you hear me, sir?
Yes, I can hear you.
Sir, it was wonderful deliberation. It was really nice and in a very lucid manner you have explained, and the way you have covered both the topics in a very short time and covered the case studies also. Thank you so much, sir. Thank you so much on behalf
Thank
of
you.
Auditing and Assurance Standard Board for covering the very important both the essays which were assigned to you for today's VCM. Sir, there are certain questions. If you permit, can we go ahead with this? The next presentation of Resusin, sir, and at the end we will take the question. Both the sessions questions.
Sure.
So next we are having with us another guest speaker, C.A. Shri Raisuddin Sefi, and he is also going to take the very important essay today. And I am on behalf of ASB of ICI. I extend my warm welcome to Raisuddin Sefi to cover the initial audit engagements and opening balances essay 510. So without wasting much more time, I request Raisuddin sir to please start his deliberation. Over to Raisuddin sir, please.
So thank you, Anil ji, and thank you, Sanjeev ji, Vishal ji, and our honorable past president Ramaswamy ji for giving me the opportunity to speak on essay 510. And I really wants to appreciate the efforts of WLSB and the office bearers who are taking the, I mean, so much initiative. I mean, this is the 26th program, and apart from this, Sanjeev ji is also heading the SRSB, and the expert panel initiative also taken recently. I mean, very commendable job WLSB and SRSB is doing. So without taking much time, because we are running 10 minutes delayed, so I'll start my presentation here.
It's fine, sir.
So is it visible? Anil?
Yes. Perfect. Okay.
So, friends, thanks for bearing with us, and thanks to Amit ji for setting the tone of the session and giving the detailed brief on SA 210 and SA 560, which were very critical in audit assignment. But apart from this, we need to understand the other aspects, right? So we will have a look on SA 510, which is initial audit engagements on opening balances. So as Amit ji mentioned initially at the time of starting this presentation, so he mentioned that whether that the auditor needs to comply with the standards on auditing. So So whether now the question is whether auditor religiously need to comply with the standards on auditing, then the answer is yes. As per section 143 subsection 10 of the Companies Act, auditor needs to comply with the standards on auditing. There is no escape, or that the auditors can take a plea that yes, I have complied with the few standards and some standards are not complied with. So we need to comply all the standards holistically. So it's not like we apply few standards and few standards are not applied. Yeah. So when we say the SA 510, if we talk about the nature of the standard, this standard talks about when we got appointed in a company as a subsequent auditor, and then the client provide us the financial statement. So we have a look on the financial statement and see that yes, there are some numbers, the balance sheet numbers, which are coming as opening balance during the year, I mean, for which we are appointed as an auditor, right? So so in that case, what kind of procedure I have to do? So SA 510 guide us that we need to follow the procedures where previous audited financial statements are audited, and what kind of procedure we need to do. We means the auditor needs to do. And where the financial statements are not audited, what kind of audit procedure we need to carry out while conducting the audit of the financial statement during the year. So SA 510 is very crystal clear what kind of procedure we have to do. Let's understand in the subsequent slides what SA 510 guide us. So what is initial audit engagement? So as per SA 510, initial audit engagement is where the financial statement for the prior period were not audited, and the second situation is where financial statements for the previous year were audited. So there can be only two situations whether financial statement prior to us were audited or not audited. The question comes when whether the SA 510 is applicable when the company is newly incorporated and we are appointed as the first auditor of the company. Then the answer is no. SA 510 is not applicable. Reason that the opening balance situation is not there when the entity is newly incorporated. So this keeping in mind that this standard is applicable on initial audit engagement, that whenever we appointed as a new auditor and replacing the previous auditor, and when we are doing the audit of financial statements where the financial statements are not audited. But practically speaking, the first situation which is displayed on the screen, the non-audited or the unaudited financial statements is very rare, because as per the company law, all the companies need to carry out the audit of their financial statements mandatorily. So the situation is very rare. But if the situation is there, then we need to follow the guidance as per SA 510. Now let's understand what is the essence of this SA 510. So as Amit Prohitji mentioned some terms of the engagement. So after agreeing with the terms and acceptance of the engagement, so we need to check whether previous financial statements have been audited. If the financial statements audited, we can rely on audit report, but apart from reliance, we need to carry out the additional audit procedures to get the comfort on the financials. So this is the area where most of the time we found that professional skepticism is lacking. So we sometimes influence that yes, that company for which we are appointed as a subsequent auditor is a part of a big group. Or sometimes we got to know that yes, the previous auditor, the auditor was the big firm or the reputed firm, and there might not be the situation that there may be a material misstatement in the opening balances coming to the year. Basically, the closing balance is coming as an opening balance is in the current year, and chances of material misstatement is very low. Like the company is big and the auditor was also the good firm. So sometimes we lack, and we, based on our gut feeling, escape this process. So this is friends, strictly speaking, this is not allowed as per SA. We have to follow the rules. We have to apply the procedure, whatever mentioned in the SA 510. And when the situation is there that the financial statement provided to us as for audit purpose are not audited, in that case, we need to carry out the detailed audit procedures, means more work to do. So we have to plan accordingly, and we have to see how we can plan our audit man hours, and how we can plan our time, how can we plan our team members for the assignment. So next is the application. So we understand the essence. Now we'll understand the application. As I mentioned, this standard is specific in nature. This standard applicable only for the previous year financial statements, where the previous year financial provided to us are audited, then this standard will apply. If the standard, if the financial statement provided to us are not audited, then this standard will apply. And what we need to do, I mean, what this standard guide us, what we have to, what the expectation from auditor by way of this standard. So this standard asks us to check whether the closing balance of the previous year financial statements is coming correctly, and those are not materially misstated and not affecting the current year financial year figures. And second is the accounting policies. The accounting policies which were applied in the previous year financial statement, whether these accounting policies are consistently applied in the current year as well, or is there any modification done by the financial head or the management of the company? Then I mean, we need to plan and analyze. The second part is the objective. So objective here is this standards wants that we have to obtain audit evidence which are sufficient and appropriate, that whether opening balance contain material misstatement that affect the current year financial statement. And second scenario is whether accounting policies are consistent, and if there is a change in the accounting policy, if you compare with the previous year, whether that change is properly accounted and disclosed. Now I'll take a few minutes, although there is a separate standards on auditing for audit evidence, but this is the gray area where we sometimes review the file of audit. We observe this point, like we got the audit evidence from client side, right? But we failed to cover up the sufficiency and the appropriateness of the audit evidence. So friends, this is very critical. Whatever document we are getting as a audit evidence from the client side, we need to assess whether that document, whether that evidence is sufficient to establish that there is no material misstatement in the opening balances which are affecting the current year financial statements. Means that this sufficiency talks about the quantity, how many sample we are taking. Then the second situation is the appropriateness. So the appropriateness talks about the reliability. So for example, I took 10 sample to test the opening balances, and that sample in itself is not reliable. That's the internally generated document by the management. And I mean, that's a clear case that the audit evidence placed in the audit file is of no use if this criteria of sufficiency and appropriateness is not met. So we need to consider this thing in our mind, that the sufficiency and appropriateness audit evidence is checked, so that we can conclude that the conclusion we are giving is correct. So this is the best part of this presentation. This is the thing why I love this standard. This is very unique thing of this standard, that this standard SA 510 is connected at all these three stages of audit, like the planning, execution, and the completion. So whenever we saw the financial statements provided by the previous auditor, and we have a look on the audit report, and based on the audit report, we saw that yes, there is a modification. In case there is a modification in the audit report, in such scenario, we need to consider that matter which was subject matter of qualification in the previous year in the risk assessment while conducting the risk assessment or the evaluation of risk. So this SA 510 came into picture at the planning stage itself, and when we are doing the number additional audit procedures, that comes at the execution stage, basically the day one when we go and start the ticking. Although the standard is more than the ticking, which we'll discuss in the subsequent slide. This is again which I discussed, the connectivity. So we discussed the planning stage connectivity and the completion execution stage connectivity. This is the completion stage connectivity. So all these reporting standards like SA 705 and 710 are also connected with SA 510. So if we are concluded that as per SA 510, there is no proper disclosure of prior period item, there is a change in the accounting policy but are not adequately disclosed, and auditor conclude as per SA 510 that there is a modification required in that report. So the conclusion as per the audit procedure of SA 510, we need to consider while drafting the audit report and considering the modified opinion as per SA 705 or giving the disclosure as per 710, the comparative figures. So in this standard, we need to see whether the comparatives are true and fair, and as per 510, whether we have to conclude whether prior periods items are adequately disclosed or the accounting policies changes are adequately disclosed, and if there is a gap in the disclosure of prior period item and the accounting policy, then need to consider the modified opinion. I mean, it's up to the auditor based on the pervasiveness and the magnitude of the transaction. Okay. As I initially discussed, this standard is divided the audit procedure in terms of the audited financial statements provided to us by the management related to the previous year, and second is the unaudited. Now we'll discuss the audited part. So when we receive the audited financial statement, first step we need to do, although we can rely on the audit report, right? Therefore, we don't need to do the procedure what we have to do in the unaudited case. So for the audited case, we need to first take the copy of the financial statements and read the financial statements and read the audit report, whether the audit report contains the modification or not. If contains the modification, then SA 315 and 300 will come into picture, and SA 510 need to conclude whether these are considered in the risk assessment or not. And friends, this is another area where we take the copy from the auditor, from the client, the audited financial statement, audit report, and place in the audit file. So read means the procedures we have done based on the audited financial statement and the audit report provided to us. We have to conclude, yes, as per SA 510, we have applied this procedure and there is no modification given in the audit report, and therefore not subject matter of SA 315. Similarly, we need to see based on the audited financial statements of previous year, whether there is an additional disclosure or some information given in the financial statements which are giving the informations to confirm the closing figures which are coming as opening balances. And the second is we need to obtain the sufficient appropriate audit evidence for closing balance of previous year, which have been correctly brought forward in the current year, and determine whether the accounting policies are consistently followed by the company or is there any change. If there is any change, then that change needs to be accounted for during the year, and that disclosure needs to be given for the accounting policy. And there are some specific audit procedure we need to carry out as per SA 510. We'll discuss in the subsequent slide, although I converted this slide into a practical case, so it would be very easy to connect. So apart from these reading the financial statements and the audit report issued by the predecessor auditor, we need to evaluate and perform some specific procedure. For example, for inventory count, we can, since we appointed during the year, so we can maximum count the year-end inventory. We can observe the year-end inventory count. But what we have to do for the opening inventory existence? So for that matter, SA says that we need to carry out the roll backward procedures to get the to understand the existence of inventory in the opening, and we need to recompute the inventory valuation and take into consider that there are multiple ratios, whether the ratio at the year end are in lines with the previous year. So we need to map whether the ratios are in order, and we need to ask management to provide the adequate reasons. It should not be like the hanky replies like the accountant is giving. These responses should come from the senior staff of the company, say MD or the director of finance at least. And the second stage is the trade receivables or payables. So for the closing balance of trade payables or the opening balance of trade payables or receivables, although we can get confirmation due to our ongoing current audit procedures, but that we can track from the subsequent receipt or payments from the customers or vendors to check whether there is a rights and obligation and the existence and completeness assertion met for the balances for trade payables and receivables. And similarly, for other current and non-current assets and the long-term debt or the other liabilities lying in the closing balance of the previous year, which became the opening balance, for that matter, we need to take the confirmation from the third party, the external confirmation. And obviously, we need to read the underlying documents also, because if the agreement or the loan which were recorded previous year and coming as a opening balance, that we need, because we are appointed as a first time auditor, we are not challenging the previous auditor, but yes, we have to comply the SA 510 guidance which is given to us, because we have to play our role also. It's our responsibility to comply with the SA 510. So we need to check whether that the opening balance which is coming as a liability or the investments, whether that actually an investment or something else. So we need to check the underlying documents also. And at last, the accounting policies. So whatever accounting policies were used in the previous year, based on which the closing numbers were arrived, which became the opening number, the opening balances, we need to see whether those accounting policies are consistently applied during the year. And if not, what's the reason for change in the accounting policy? If that change of accounting policy is duly accounted for and disclosed, that's okay. Otherwise, there is a problem that needs to see whether we need to modify the report or not based on the magnitude. So let's understand these procedures by way of case study quickly. So this is a case one where auditor conducted the audit procedure as per SA 510 and conclude that the opening balance of inventory is overstated. Then what audit procedure does the new auditor needs to carry out? So here, auditors have determined, first of all, the magnitude of that that overstatement of inventory on the current year financial statement. Second, if that's material, then that needs to be strictly communicated to the management or those charged with the governance as per SA 450. And if that's concluded that material and numbers are misstated for the year, then needs to report in the audit report and modify as per SA 705. So for the modification, there is a separate standard SA 705 needs to take the guidance. So please have a look if there is a situation of modification of report SA 705. So this is the second one, the interesting one. There is we received the financial statements and based on the previous financial statements, previous auditor had made a qualification in the IFCFR report relating to material weakness on particular matter. So what auditor needs to do if material weakness is corrected or material weakness is not corrected? So it's very simple. If material weakness is corrected, then no modification in audit opinion. If material weakness not corrected, we need to consider SA 705 and see the modification in the audit opinion. Third, this is the further interesting. The previous auditor has mentioned a qualification regarding the understatement of provisioning of non-moving inventory. And in the current year also, the situation is same. So what audit procedure does a new auditor needs to carry out? And obviously that we are discussing here, this assuming that this point is material enough, then auditor needs to modify the report for the current year and previous one. And similar for the same example, if company provides adequate provision for the non-moving stock and make adequate disclosure in the financial statement for the facts of provisioning, then not required to modify the opinion based on the previous year modification. So these were the procedure guided by SA 510 regarding the situation where the financial statement provided to us were audited. And the second situation is where the previous year financial statements are not audited. So obviously we have to do more work and see what kind of procedure we need to do. So here I have jotted down some points here. So we have to perform audit procedure related to opening balances, whatever mentioned earlier, and see whether the presentation and disclosure given in the financial statements are adequate or not, and the accounting policies consistency, whether the unaudited numbers coming are based on the accounting policies consistently followed by the previous year, right? And obviously, since the numbers are not audited, we need to consider this fact into the risk assessment and perform the control testing, how management is controlling the financial reporting. So that factor needs to be considered. And the numbers who are coming as opening balances, for that we need to read the underlying documents such as agreements with the bankers, customers, and the other parties like vendors or the capital creditors, etc. And the last is we need to assess whether proper disclosure of contingencies and commitments were given in the financial statements. It's very critical. There might be a situation that the financial statements were prepared by the management, that they may not disclose this fact because the financial statement was not subject to the audit. Then we need to see, apart from the above procedure, that the contingencies and commitments are adequately disclosed or not. So friends, these were the procedures defined in the SA 510 for both the two situations. Now we'll have a quick look what would be the situation where material statement is there in the opening balances, and how we'll track whether the audit report needs to be qualified or the unmodified opinion. So it's the conclusion stage of this essay. So if opening balances contain no misstatement, then unmodified opinion. If opening balance based on SA 510 concluded that the company is not able to provide the audit evidence, then disclaimer of opinion. It's very clear. And if opening balance contain misstatement, I am not saying material misstatement, I'm saying contain misstatement, then if having no impact on current year financials, then unmodified opinion. If having impact on current year financial statements and the impact of opening balance misstatement is considered during the current year, then unmodified opinion. And obviously the fact of that misstatement is clause in the financial statements. And on this same lines, if the current year financial statements are impacted by the misstatement, then we need to see why the management is not considering the prior period items impact in the financial statements, and if not recording it, not considering the impact of prior period item, then we need to modify the opinion. let's understand these situation also by way of quick case studies. New auditor concluded that opening balances contain material misstatement that materially affect the current period financial statements, because we are focusing on the current period financial statements only, and we are giving the audit report on current year period financial statements, current period financial statements, because as per Indian law, we need to report on the current period financial statements. And the effect of misstatement is not properly accounted for, what we discussed recently, or not adequately presented or disclosed. The new auditor shall issue qualified or adverse report. Option B, a disclosure of opinion. Option C, withdraw from audit engagement, resign. Option D, none of the above. The answer is A, qualified or adverse report, if not resolved by the management, and if the numbers are affected due to the material misstatement. Second situation is post acceptance of an audit engagement. For example, for 21-22, the new auditor started performing audit procedures and obtaining audit evidence for the opening balances. The management of the company interrupted and asked the auditor not to perform such procedure, as he has been appointed as auditor for 21-22 and not for 2021. Why you are asking, why you are asking information for previous year? Why you are providing additional list of documents for the opening balances, right? So this can be the situation. What in that scenario, what auditor needs to do as per SA 510? So at SA 510 clearly guide us. If auditors in that scenario, auditors there would be two scenarios. Auditors should not perform such audit procedure and consider the contentions of the management, or auditors should explain that work done is in accordance with SA 510, and if the management is still not allowing to perform such procedure, then modify the opinion. What's the option auditor needs to consider? So the option is B. Auditor should explain, educate the client that I am doing this thing or giving the additional list of document for the opening balance checking in lines with the SA 510. This is my responsibility, duty. I need to honor this as per the law. And if still management is not aligned, then modify the opinion. So there is one more para, like the other matter paragraph. If we are appointed as a subsequent auditor, that so the standard requires to disclose the fact that the previous year financial statements were audited by the another auditor, and particulars of the audit report, like the audit report which were audited by the previous auditor contains the modified opinion or the unmodified opinion. So this is the example, the screenshot of example given in this SA 510. You can have a look on this. So friends, so this was the overall crux of this standard SA 510. So based on my experience, I can just say that the key takeaway, if you want to take the key takeaway can be the professional skepticism. So professional skepticism we have to follow while conducting the audit as per any standard, even if SA 510 or the other standard. When we are checking the opening balances, so we need to take in our mind that yes, I need to follow the and which is my primary responsibility while doing the audit. It should not be like we'll rely on the previous audit report only, or we'll rely on the management's or the company history. And second is we need to apply the standard auditing in a holistic manner, not only on a single standard. So if I am working on SA 510, I need to connect with other standard also. What are the repercussions if based on the conclusion on the respective standard? If as I mentioned earlier in the previous slides, this is connecting SA 315, 300, 450 also, and this is connecting SA 705, 710 also, although we are working on the execution stage, right? So we need to connect. We need to see what the impact of these standards are coming for all other standard. Otherwise, there may be a conclusion that the standard we are complying SA 510, but if we are not considering the impact of SA 510 in SA 315 risk assessment, there is a failure. So we need to sync. So this is clearly mentioned in the SA 510 also, that 315 and 705, these are 710, these are synced, these are connected. We need to see in a holistic manner. And the last is document, document, and document. Whatever audit procedures we have done as per SA 510 or the other standard, if not documented, believe me, it's not done. If not documented, it's not done. I have to, if I am applying the audit procedure on SA 510 for the opening balances, or I'm applying or for the other standard, so I have a work note or working paper I should have a working paper in my file which can substantiate that what kind of audit procedures I have done. I have done based on the standard SA 510, and whether I have linked that SA 510 conclusion with the other standard, that document should demonstrate. Even in the recently, as per QRB report, there was an observation for SA 510 that auditor was not, the auditor was saying that yes, I did the job, but there was no document to substantiate that yes, we have a sufficient appropriate audit evidence to conclude that yes, I have done the SA 510 compliance. So this is very serious affair. Whatever we are doing, everything should be in our file, and the document should be very crystal clear. That should state the purpose of the work paper, source of the information, extent, conclusion, nature, time, everything should be there in the work paper. That work paper should be very clear that why we prepare that work paper and the conclusion we are expecting from that work paper. So that's all from my side. So anything, any questions we can take up. I try to wrap it up based on the commitment given to me. It's open.
Thank you so much, sir. Thank you so much, sir, for your best and wonderful presentation. We are having with us certain questions. Amit sir has also joined. Sir, I will raise few questions, and the question relating to any of you may please answer. So Amit sir is also there, Aishuddin sir is also there. Sir, the very latest question is a concurrent auditor appointed for 2 years and having compiled with SA 210 and submitted audit report for the services as noted in SA 210 was removed by the management. Government owned society. It's the case of one government owned society, and management has removed SA 210, which the auditor has mentioned for both the years. Auditor is a MSME registered unit. Reason primarily is to bringing out the defaults of the management, but management holds out the auditor failed to do few things, which is against SA of ICI. What are the remedies open to the auditor?
Can you again summarize the question? I mean,
Yes. A concurrent auditor appointed for 2 years and having compiled with SA 210 and submitted the audit report. For the 1 year, along with this, is billed for the services as noted in SA 210. Now, it was removed by the management, that is one of the government-owned society for both the years. Auditor is an MSME registered unit. Reason primarily is for bringing out defaults in the management, but management holds out the auditor failed to do few things, which is against the SA of ICI. So what are the remedies available with the auditor?
see, basically, so far as the removal is concerned, again, the contractual terms will have to be seen, whether the appointment is on an annual basis or this incumbent was removed during the term of his appointment. And another remedy would be under the terms of the contract. Now, if there is an unjustifiable removal, then he may go to the appropriate forum for remedying the defects. Otherwise, if the management has decided and the auditor has given a clear-cut report about the deficiencies which he has found out, so he need not worry about anything. So far as you are faithful to the auditing standards, that's the job you are supposed to do and you have done.
Yes. So how is scenario if audit engagement letter is issued on the letterhead of the auditor? Is it proper for the management to courier, sign and to engagement letter, which is one of the auditor's letterhead?
So normally the practice across the firms is that the engagement letter, again a very good point raised, Engagement letter is generally on the letterheads of the auditors, where at the end of the letter, the auditor signs, and at the end, he requests the management that you countersign it. So auditor sends the hard copy, management receives it, and they sign it, and they again send it back to the auditor. So normally the audit engagement letter is generally on the letterhead of the auditor. But there is no precedence that it has to be on the letterhead of the auditor. But it is a practice.
Right, and just to add on to the Amitji point, so when there is a case of joint auditor, right? So in that case, sometimes they issue the joint engagement letter. So for that matter, I mean, the question of this letterhead may not come. So.
Correct.
So in that scenario, the firm name and the address on the top of the document can be given, and that can be issued.
Correct.
Sir, in case of partnership firm, there is no statutory audit requirement.
Correct.
Can the management auditor? Question is, in case of partnership firm, there is no statutory audit requirement. Can the management auditor of the firm can also be the tax auditor under section 44AB?
Now this is a question of the Income Tax Act. Let me here point out that under the Income Tax Act, there is a section called 288, which defines the auditor or the accountant rather. There is a term called accountant under section 288 of the Income Tax Act. So there it gives certain disqualifications for non-company clients. So one will have to go through that list under the income tax and then find out whether to do the tax audit is possible or not.
Yes. So another question is, auditor is appointed by the shareholders and report is to be submitted them. IPS so facto. Is not appropriate then that terms of engagements are also informed to them at the time of appointment or the next earliest opportunity. This may help to reduce the expectation gap, at least with the shareholders.
So as the provisions which are worded at present, the appointment is done by the shareholders. The terms of the engagement are entered with the board of directors or those who have got the authority to manage, like audit committee in case of the listed entities. But if we see the current scenario where the regulators have become very strict, and if they see that there is no reason, or if there are some reasons given by the auditors about his resignation, which speaks of something, then they quickly come into play and pull up the companies. So the regulators are also becoming more and more proactive. And this is the process right now that the engagement letter is executed with the board of directors.
Yes, sir. Thank you. So can the various assignments of one organization be clubbed in one single engagement letter or separate letter are required? Do we need to take engagement letter every year of the audit engagement?
No, so like I explained to you, there are two options. Again, there are two limbs to your question. Whether I can combine all the assignments which I am going to do for a particular client in one single common engagement letter, or in the next question was whether I need to issue engagement letter on a yearly basis or not. Now, it is always better to club all the services which I'm going to provide to the client in a single common engagement letter. So long as the services are permissible under the regulatory, the law which governs the entity, then you can cover all the services in a one single engagement letter and giving the recitals for those services. It would be very prudent to include all the services at one place. Now, coming back to the next question, like I mentioned in my presentation, that since in case of a company, the appointment is for 5 years, you need not exchange the engagement letters on a yearly basis. You will change the engagement letter, or you will update the engagement letter, or you will share the addendum with the management only when, if there are certain circumstances which you feel that you should appraise the management about. In those situations only, there will be a separate engagement letter or the new engagement letter in the subsequent year. However, I am of the view that if there are no changes during the term of 5 years, then there can be a one engagement letter which was executed at the beginning of the appointment. However, in the second term of 5 years, I would like to go for the new engagement letter.
Sir, in the same, I hope you have answered. Another member has raised same question, which you have explained in your deliberation also. Engagement letter is required to be obtained before the commencement or can be obtained before completion since it is existing audit client.
No, so as such, the audit engagement letter is a first and foremost process to be completed by the auditor. So once the appointment is made, the auditor is notified about his appointment. Then the first step would be to discuss with the management to understand the entity and execute the audit engagement letter. However, during the currency of the audit, if there are certain changes with the management or the auditor wants to make, then he will discuss with the management and make those changes which are acceptable to the auditor.
Yes, sir. Sir, one question is for Yasuddin sir. Sir, member is asking, sir, can you put some gist for the members initial audit engagements? What you are suggested while making the audit to how to use this SA 510 more effective.
So this is very interesting. So first of all, if we are saying the implementation of SA 510, so we should develop a checklist, the program.
So member is asking the effective use of SA 510, how at the time of initial auditing.
Yeah, that's I'm telling you. So
yes.
For effective use, based on the SA 510, so we should develop a checklist. We can become the audit manual program of the firm, right? So who is doing the audit, and that checklist should be handy before going to the or before commencement of audit assignment, right? And that checklist should be in lines with the SA 510 audit procedures, right? And this should be micro one. This should not be the macro one, right? So the each and every audit procedure, what team needs to execute, needs to be mentioned there. And in case of there are lacks also when we go for the review of audit files. I'll tell you, the firms are having the audit program, but they don't have the instructions to use that audit program, right? So audit program is there, tick and tie options is there, but what the team member needs to do when trainee is going for the audit, he must understand the documents entity, what kind of information he need to put in. So first of all, the audit program should be for the opening balance as per SA 510 should be handy with the firm, and the instructions with the SA 510 should be there. And the most important is the meeting with the audit team member. At the planning stage itself, the engagement manager and the partner should embrace and should explain the team members that these are the requirement as per SA 510, and these are the audit procedure mentioned in the checklist based on the 510. These need to be complied with, and that checklist should be placed in the audit file.
And just to supplement and taking cue from what Raisuddin said, now checklist is a very good thing, and we need to employ this checklist for all the auditing standards which we are going to follow. Sometimes in checklist, the audit team just simply feels yes, no, ticks it, which is not the intention behind formulating the checklist.
Right.
We need to have a clear remarks column alongside the ticking, yes or no, and which should clearly demonstrate what is the evidence we had gathered, how we came to the conclusion, what are the documents we had checked. All these things should come in the remarks column or some appropriate column. Otherwise, just ticking is, it has to be an application of mind, and judgment has to be demonstrated.
So basically, Amitji rightly pointed, the moment the audit team member tick, so there should be a basis of that tick.
Yes.
The underlying document should be available with that checklist. That these are the number, or the reference can be given in the audit file that this document is lying in particular caption.
Yes. So thank you so much, sir. Now we are at the end of today's VCM. both the eminent speaker, both the learned speakers have shared their expertise as well as their expert opinion on all the three essays, essay 210, FI, 510 and 560. And thoroughly, I have gained a lot with all the two presentations with the CA Amit Purohit as well as CA Raisuddin Sethi. And once again, thank you so much on behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountant of India for sparing your valuable time, and on this very peak period, very, very important and very hectic period, you have given your consent to deliberate on these three essays. Thank you so much, Amit Purohit. Thank you so much, Raisuddin Sethi.
Thank you.
Once
so
again,
much.
thank you so much.
Thank you.
Thank you.
Thank you. Thank you.
Thank you very much. Thank you.
Thank you.
Thank you.
Thank you, everyone.
Thank you.
Namaste.